In this video, we're going to talk about everything you need to know to go ahead and start investing into stocks profitably. Everything from A to Z when it comes to stocks. So we're talking about what is a stock, how do you buy a stock, what causes a stock to go up or down, why invest in stocks, the pros and cons, I'll weigh both out, why pick individual stocks over ETFs or managed diversified funds, the type of stocks that you can go ahead and pick and choose, basically the type of investor you want to be, and how you're actually taxed on your profits. That's the most highly sought out question I've been getting on the channel. Stay right to the end to go ahead and see exactly how your profits are going to be taxed. My name is Pietrobono. On this channel, I post financial education, stock investments, and I share my own portfolio with you. So if you're interested in learning more about how to invest in stocks or go ahead and build long-lasting wealth, consider subscribing. Let's dive right into the video. A stock is ownership of a company. That's all it comes down to. So when you buy one share of Apple, you are essentially buying a very, very small fraction of the company. This is the way you need to think of it, is whenever you think about whatever company you want to invest in, you just think about what company do I want to own? What company do I truly believe is going to be increasing in value over the long run? And that's how you're going to make your decisions when it really comes down to basics. When you buy one stock, you essentially own a share and a part ownership of that company. Whenever you think of stocks, think of companies. Over the long run, the stock will do what the company does. So if the company is succeeding and growing, the stock will, over the long run, most likely increase in value. Now, when it comes to actually buying a stock, the way you do this is you set up an online brokerage account. Now, if you're in Canada, I personally use Qtrade. You can also use Questrade. These two, in my opinion, have the best fees, the lowest fees, and great user interface. I have accounts on both, but I primarily use Qtrade. If you're Canadian, that's what I would suggest. If you're in the US, you can use TD Ameritrade or Fidelity. Those are the two, in my opinion, that are the best with the lowest fees and the widest range and most sustainable that you can go ahead and choose from. To do this, all you do is you type in those names I just mentioned into Google. You'll go to the website, create an account. Once you've created your account, you're then gonna follow the step-by-step process to go ahead and link your bank account to this account. Then you'll go ahead and transfer money from your bank account to this online brokerage. When you're on that online brokerage, once you get approved by them and you go through all the paperwork, you go on the interface and you're able to search individual businesses, companies, stocks, and you'll go look at the stock prices. And once your funds have transferred from your bank account to this new account, you'll see the balance in this account and you go ahead and just click buy or sell if you're planning on shorting. It's quite simple. No matter what brokerage you choose, you'll always see a step-by-step process to go ahead and link your bank account to this online brokerage account. It can just take a few business days to go ahead and actually transfer the funds from your bank account to this online brokerage account. Just think of this online brokerage as a separate bank account. If you already set up your account and you're still unsure how to actually buy a stock, just type it in Google, how to buy a stock on your specific brokerage, type in the name. If it's Fidelity, type in Fidelity. If it's Qtrade, type in Qtrade. And there's plenty of guides. I've searched them up. You're gonna go ahead and look at one of those guides and you'll be able to buy a stock very simply. The next question is, what causes a stock to go up or down? This one is extremely valuable to understand. The only thing that causes the stock price to go up and down is the amount of buyers and sellers. Whenever there are more people in a given day buying a stock than there are selling that same stock, the stock price will go up. Whenever it's the opposite, when there's more people selling the stock than there is actually buying the stock price will go down. It's all about supply and demand. So there's a certain amount of shares issued for a company. And whenever you go ahead and buy a stock, that means there's less stock available. So the value goes up. Whenever someone's selling a stock, that means there's more stock available. So the value goes down. This is the only thing, the root thing that truly changes a stock price. In a given day, if there's more people selling the stock than there is buying it, it goes down. If there's more people buying the stock in that same day than selling, it's gonna go up. That's what it all comes back to. However, we can go lots of layers deeper into this, and I'll brush on it quickly now. Because now you can say, okay, what causes people to sell a stock or what causes people to buy a stock? And that goes into a whole new can of worms. I can tell you a few points right now. So there's fundamental analysis, which is basically whenever news comes out on a company saying that they beat their earnings, that's fundamentals. That is the company improving. They've done better than the expectations of Wall Street and everyone else. So people are going to flood into buying the stock because they're doing better than people thought. And when they do better than the experts think, everyone floods in and buys the stock. Now, the vice versa can happen. If there's some negative news that comes out where the company did something bad, or there's some lawsuit against the company, a lot of investors won't feel comfortable owning a share of that company anymore because they think, wow, there's this lawsuit going on. I think this company's going downhill. Let me sell my shares. Well, what happens to that? When they sell the shares, the stock price goes down. This causes the day-to-day fluctuations in the stock price and the changes over the long run. But always bring it back to the basics. What changes the stock price is if there's more buyers than sellers, it goes up. If there's more sellers than buyers, it goes down. The next question is, why invest in stocks? Out of all the different assets you can invest in, why choose stocks? The biggest ones I can think of right now is real estate. The biggest ones people talk about is a comparison from real estate investing to stock market investing. And the question just becomes, what is your preference, essentially? What are you more interested in? Because whatever you're more interested in, you're gonna put more time, energy, and effort in. And when you put more time, energy, and effort into it, you're gonna get greater returns. Because at the end of the day, what matters most when it comes to investing is how great your returns are. Here are some pros to investing in stocks. Number one is you put your money to work and you technically don't have to worry about a tenant or other issues or other costs that can sneak up on you that there are in real estate, where properties can get damaged, you have to pay a bunch of other fees, the tenant can leave. There's a lot of other unknowns, technically unknowns, that could come up. However, there are also unknowns in the stock market, black swan events that can come up and destroy a company, something you would never foresee. A CEO could pass away. If the CEO, like Elon Musk, if he is the true leader and everyone's betting on Elon Musk, and they don't believe that the company can be as great as it is without him, and then he suddenly passes away, what do you think everyone's gonna do? Everyone's gonna sell a stock, and the stock could have a massive 20, 30, 40, 50% drop. So there's unexpected events that can occur in both camps when it comes to real estate investing and stock investing. In my opinion, a stock investing can be more hands-free, because you're not using physical hands to do these things, but it also requires just as much, if not more, research, staying on top of things if you invest in individual stocks. There are more tax benefits to real estate. When you buy and hold real estate and you have it rented out, there are additional tax break benefits that you can get from real estate. Stocks are taxed differently than real estate. They don't have as many tax benefits depending on the way you're investing, so that could be one con to investing in stocks. However, you can get greater returns with stocks if you choose growth investing and you choose individual stocks as opposed to real estate investing. You can also make the argument, if you're doing real estate investing, that you can renovate and refinance a property to get much greater returns than you would if you were a buy and hold investor. At the end of the day, it really does depend on the individual. It depends on what you prefer, what you're gonna put more time, energy, and effort into. What are you more interested in? Are you more interested in sitting back, looking on your computer, and researching and just looking at the numbers? If you're a big numbers guy, you can go deep into stocks, do all the research, and sit back and wait and have it more hands-free. Or you can research every day if you're really interested in it. It just depends on what you want to do, what you prefer, and go with that route first. Because whatever you prefer the most, you're gonna get the best returns with. Now, a lot of people ask, why would you invest in individual stocks rather than index funds that are diversified and safer? Here is the big kicker. You gotta pull up the charts for this one so you can see numbers. Quick little update, the account is at 540,000 right now. If we put in time, energy, and effort into researching the companies, we can potentially get greater returns than we would if we just put our money into a fund. However, if we're not going to put time, energy, and effort into researching, that's when the index funds are perfect. I'm going to show you the incredible impact just a small difference in percentage gains can make over a 10-year span. If you were to invest in VFV, which is a Vanguard S&P 500 index ETF that I highly suggest if you're not going to do research into stocks, you'll see that the average annualized return over the last 3 years was 11%, average over the last 5 years was 12%. So let's just go high and let's use the 12% average annualized return. If we make the assumption that it will grow at the same rate over the next 5 years, each year, and we put in $10,000 in right now, and we don't contribute any more money, you'll see the starting amount is $10,000. After 5 years, average return is 12% each year with no additional contribution. You press calculate, you'll see your ending balance is $17,000. That equates a 76% return on your investment over a 5-year period. So you had 76% in gains over a 5-year period investing in the fund. Now, if we take a look at a tech company like Apple, and you'll see this is a 5-year chart. At the bottom, it says each year. 2020 is here. We go all the way back to 2016. So if we go to the very beginning of the chart, it says 129 was the stock price. And today it's at 385. From 129 to 385 is a 298% return. So if we go back to our investment calculator, we just look here, what is 298% returns on 10,000? Well, what you do is you multiply the 10,000, you get a calculator out, 10,000 times 2.98 equals 29,800. So you are getting $29,800 in gains on top of the 10,000 that you put in. That's what represents a 298% return on your investment. So this $10,000 in 5 years became $39,800. So if you just invested in Apple 5 years ago, 10,000, your 10,000 would be 39,800. If you invested in a solid, stable ETF fund that got you 12% a year, steady, good, pretty 12%, not very volatile though, which is awesome for people who are afraid of the volatility, you would get 17,600 by the end. So your money is 2 times more than investing in the fund. 39,800 as opposed to 17,600. What if you're using more dollars? What if you put 100,000 in back then? Well, your 100,000 5 years ago is $398,000 5 years later in Apple, as opposed to your 100,000 being 176,000 in the ETF fund. We can't argue that 12% annually is bad. We can't say that 12% annually is bad. A lot of people would love that. However, if we invest in the growth companies, the technology companies, companies we believe in, that we truly believe are going to grow over time, the rates of returns are incredible. What if we stretch this out to just 10 years now? If we take a look at the 10-year chart, and just an example, let's use a different company. Let's look at Amazon over the last 10 years. 10 years ago, if we scroll to the bottom here, we can see the stock price was $118. Today, we're looking at $2,931. That is a 2,483% return on investment over 10 years, which is a 24.8 times, which means you would earn 24.8 times your money if you invested in Amazon 10 years ago. So let's take a look at what that means. That means if you put 10,000 in Amazon 10 years ago, today it would be worth $248,000. Your 10,000 is $248,000 before taxes, of course. But I'm just trying to show you the difference. Now, if you invest in a safe ETF fund, that 10,000 over 10 years at a 12% return, adding no more money in, turns into 31,000. Take a look at that. All right. In the Apple example I used, your 10,000 turned into 39,000 in 5 years. So you got better returns in 5 years than you did in 10 years in the fund. However, the question is, did you know that Apple would do this well 5 years ago? Maybe you did. Did you know Amazon would do that well 10 years ago? Most likely not. Would you have invested a large sum of money in Amazon 10 years ago? Maybe not. You would have if you were doing a lot of research and you have the confidence and you have the awareness and you would go ahead and pull that trigger. But if you didn't do a lot of research and spend a lot of time, you wouldn't have the confidence to pull that trigger, number one. And number two, the confidence to hold on to that stock for that entire period of time. You would be so tempted to take the profits when Amazon went from 118 to 300. Because you're like, holy crap, that's like a double, more than a double on my money. Let me take those profits. Meanwhile, you missed out on Amazon going from 300 to 3,000 over the next coming years, which would have gotten you from 10,000 to the 248,000. So that's the even trickier part. We can talk about that in another video. The truly trickiest part about investing is actually holding on to your winners and having the belief, even though the volatility is hitting you day by day. Trust me, it's a lot easier said than done to buy and hold a stock through volatility than it is to believe in that company for years and years on end. This is why people go ahead and buy the fund, because it's not very volatile. There's not massive swings up and down that are going to scare them into selling their shares. There's a nice, basically steady climb. It slowly goes up and down. Yeah, it goes up and down a little bit, but it's far less than these other companies. The volatility is what shakes investors out and causes them to sell.
But if you truly do enough research and you believe in the company with enough conviction and you hold it to the end, you will see the greater results. Now, let me go a step further and just show you how a small improvement in annualized gains can make over a long period of time. So let's say you, instead of making 12% returns, you chose some individual stocks, and those individual stocks are giving you 15% returns each year. Well, over a 10-year period, instead of having 31,000, you would have 40,000. What does this look like if we blow it up even more? What if we have more money? If we have $100,000 and we invest that into a fund that gets us 12% over a 20-year period, and we don't invest anymore, that's going to turn into 964,000 over 20 years. Our 100,000 turns into 964,000. Now we look at that and we think that is great. What if we chose our own individual stocks and we had some bad years, we had some amazing years that went up 100%, but we had some years that went down 20%. But at the end of the day, the average annualized return over a 20-year span came out to be 15% by picking our own stocks. Well, our 100,000 would turn into 1.6 million. 1.6 million. That's $700,000 more in gains for doing nothing, just doing your own research and picking your own stocks if you did so successfully. This is the true power of compounding interest when you choose your own individual stocks. An amazing target to go for if you're an investor who puts a lot of time and energy and effort into researching stocks is 20% average annualized returns. And if you get 20% average annualized returns, with your 100,000 over 20 years, you can turn your 100,000 into 3.8 million in 20 years without putting any more of your own capital into this account. Now you see the power and the reasons why people put so much time, energy, and effort into researching potential investments. If we take a look at my own account, in the last year, I've gotten over 300% returns in 1 year. Now, do we think we can get 300% returns a year for 10 years? Definitely not. No. Could I get 300% 1 year and lose 20% the next year? Yeah, but I'd still be up an insane amount, far more than someone else investing in a fund. This is why we choose to invest in individual stocks, because the upside is far greater. It can be incredible. You don't have to earn a lot of money, but it can truly pay off in the end.
Now you want to decide what type of investor you want to be when it comes to stocks. There's lots of different types of stocks. I highly suggest reading the book One Up on Wall Street by Peter Lynch. He talks about the 6 types of stocks. There's the slow growers, the stalwarts, the fast growers, the cyclicals, the asset plays, and the turnarounds. When you think about slow growers are basically value companies. Those companies that are pretty much done growing. They're very small, incrementally going up. Could be something like a McDonald's, a Coca-Cola. The ones that pay higher dividends, those are typical slow growers that may go up anywhere from 3 to 8% a year, and they pay a relatively good dividend because they've developed over time already. The second category would be stalwarts, and those are people those are companies that are growing a little bit faster. It could be something like a Walmart that still have some growth potential, a little more than the slow growers. May not pay a dividend, or the dividend is small, but they have that element of safety there. The first two that I just named there, the slow growers and the stalwarts, they essentially have the best safety because they've already been developed. They're a trusted company. They've been around for a long time, and they still have some growth in them. So they're a good play, but they also carry a dividend, which pays a little bonus extra on top. Those are typically great for people who are highly risk averse. The next play we have are the fast growers. These are the technology companies. These are the innovative companies that are doing something new. They're the fast growers because they're disrupting the industries that the slow growers are in. That's their goal. Their goal is to come in and disrupt them. The risk lies in that there are plenty of smaller companies that are striving to disrupt the industry, but so many fail and so few actually succeed. However, the one that succeeds explodes because they disrupt the industry. So they become the new Apple. Apple disrupted the industry. They become the Amazon. Amazon disrupted the industry. These are the fast growers, and these are the ones that you would get the greatest returns on. However, back in the day, there could have been plenty of Amazons or that have failed in the past who tried but didn't have the execution there. With the fast growers, this is where you get the things that Peter Lynch talks about with the 10 baggers. These are companies that literally 10x. If you read the book by Peter Lynch, One Up on Wall Street, you'll see plenty of examples where he shows 45 X's in stocks over a 10-year span, a 20-year span, 100 X's on stocks in a 15-year span, 10 X's in a 3-year span. That's talking about a $10,000 investment turning into $100,000 in a span of 3 years. There's companies out there, people don't understand that. Another thing you have to understand is a 10-bagger, a 10x company is a 1,000% return. A 2x on your money is a 100% return. Here we are talking about going for an average annualized 8% return. Meanwhile, there are companies out there doing 1,000% over a 3-year span. And they're out there, people don't realize this. And you might be saying, yeah, but they're too risky to put all your money in. If you do enough research over a period of time and you're confident in your ability, you can put some money in there and go for those fast growers. This is what people call growth investing, going for the fast growers. I personally am a growth investor. I go for the companies who I anticipate the most growth. Now, it's tricky to teach this because you can't really look at the balance sheet when you're making the decision to invest in a company. You certainly should look at the balance sheet, but the problem is you can't rely on the balance sheet and look at the balance sheet and be like, oh yeah, their balance sheet is healthy, yep, they're making money, so I'm gonna invest in them, I think they're gonna grow over the long run. If you did that, you wouldn't make the best decision in growth companies. So growth company investing, the strategies are completely different from the slow growers and the stalwarts, because those companies, you really want to rely heavily on the balance sheet, the income statement, all the financials. With the fast growers, you're anticipating the future and relying heavily on future expectations far more than what they've done in the past. Next up, we have the cyclicals. Cyclicals are actually the automotive industry. The automotive industry sells the most cars in the last quarters of the year. The beginning of the year, they don't sell very many whatsoever. So you'll see revenues go up and down, and potentially you'll see stock prices go up and down based on this. There are other examples of cyclicals, but the point is you can do more swing trading, betting on selling near the ends of the quarters of the years and buying on the earlier quarters of the years. There are companies like asset plays. These are companies that have a tremendous amount of assets, 100 billion, 10 billion in today's standing, where they really are the most safest because they have such a high amount of assets and compared to their debt ratio that they are a safer play that are going to go up in the long run because they won't get wiped out by any uncertainty. That could be your kind of play. And the last one are the turnarounds. A great example of a turnaround would actually have been Tesla of last year when everyone was saying Tesla was going bankrupt. All the media was hating on Tesla, saying they're going bankrupt, they got all this bad stuff going on, autopilot is killing people, the cars are blowing up, this is all over the news, and Tesla was actually a few weeks from bankruptcy. Just around 2 years ago, around the Model 3 ramp when they had the tents going, Elon Musk literally said they were 2 weeks away from bankruptcy. So that would have been an example of a turnaround. You were betting on, here's a company, Tesla, being hated on. They were doing pretty well and started getting hated on, and it's looking like they're going to crash and burn, and you're betting on the turnaround, and you start to see a glimpse of bright light where they're starting to go off. That would have been the earnings report of Q3 last year where they had the profit, where they posted the profit. That would have been your sign of the turnaround, and you would have bought in on the stock at 260. I remember this. You would have bought in the stock at 260 because the stock was around 240, and I remember the earnings came out and it went up 10-20% overnight, and it was around 260 to 280. And ever since then, it's been a straight tear. This is around November of last year. So if you were betting on the turnaround, you would have invested in November of last year at the stock around 260 to 280, and you would have quadrupled your money in less than 1 year. That is a 400% return on your money in less than 1 year. You would have gotten returns like that if you were a turnaround investor and if you successfully timed that. Those are the types of stocks and those are the types of investment strategies that you could go for. You'll have to, again, it all revolves around what's your flavor? What do you prefer? What kind of investor are you? Again, I am more in the growth camp. You could be more of a dividend investor. You could go for the slow growers, the cyclicals, the asset plays. Do more research into this, read the book, and figure that one out for yourself. The question you've been waiting for, how are you taxed on your profits? Now, if you live in Canada, you're taxed 50% of the capital gains that you receive, and you are only taxed when you sell. So If we use an example, if you buy a stock at $500, the stock goes up to 1,000. You bought one share. It went from 500 to 1,000. Your capital gains, the money you've made is $500 because the stock went from 500 to 1,000. You bought one share. The gap there is 500. So your profit's 500. 50% of that is what you'll get taxed on. So 50% of the $500 in profits you made is $250. What happens to that $250 is it's added to your current income. In 2020, let's say I've made $100,000 with my business and my job and everything. I've made $100,000. Now, I'm adding $250 in the capital gains I've made on top of the $100,000. So now I'm taxed on $100,250. Now what we'll do is we take a look at the Canadian tax brackets and you'll see how that affects you at each tax bracket level. But remember, you only get taxed when you sell. Once you sell, the capital gains is triggered and you're now going to be taxed on 50% of whatever the gains are. Check for yourself if you live outside of Canada, but this is how it works in Canada. So if you made $100,000 in capital gains in 2020 from your stocks and you sold in 2020 and you took that $100,000 profit, you're now getting taxed on $50,000 of it. If you made $100,000 from your job and $100,000 in capital gains, you're not taxed on $200,000. You're taxed on $150,000.
Now, for those of us in Canada, this is how our tax brackets are going to lie. 15% on the first $48,000 of earned income. Then it goes up to 20% for the next $48,000 of taxable income up until $97,000. If we've earned more than $97,000, then the next bracket is going to be 26% on the portion that is above the $97,000 up to $150,000. And it continues up as we see here, as the tax brackets get higher, the percentages increase on those amounts. Let's run through a scenario real quick. Here's how it would actually play out. These are all the tax brackets. Let's say in 2020 you earned $48,000 from your job. That's about $4,000 a month before tax. You would be taxed 15% on that because 15% on the first $48,535. Now, let's say you also claimed $100,000 in stock gains, capital gains. You sold enough stock to trigger a capital gains of $100,000. Well, remember the rule. You're taxed on 50% of capital gains. So we would half that $100,000, that becomes $50,000. So now we add the $50,000 that is taxable capital gains to our own income, which is $48,000. The total is $98,000, and this is where we start to look at the tax brackets. So remember, first $48,535, we get taxed at 15%. So the first 15% off that becomes $7,280 in taxes first. Then there's 20.5% that is taxed on the next $48,000. Bringing us up to about $97,000, close to $98,000. So we're just going to round up in this case. So what we do is we take a look at this number here, and that leaves us with $49,000 left. So all we did was we take the $49,000 and we multiply it by 0.205 to get 20%, and that leaves us with another $10,140 to pay in taxes. So the total we pay in taxes for the year of 2020, when we add our $100,000 in capital gains on top of the $48,000 earned, is $17,420. That's how the case would play out if you earned $48,000 in 2020 and you had $100,000 in stock gains that you claimed.
Hey, please give this video a thumbs up if you enjoyed the content, you found some value from this. Subscribe for more financial education content just like this one. Also, my portfolio updates. I told you I'm gonna share everything I'm doing each week or each month with my portfolio, the changes I'm making. So if you'd like to follow along with how I'm building my wealth, as well as learning exactly everything I've learned over the years, consider subscribing.